Let's play a quick game. Person A earns $150,000 this year from salary. Person B earns $150,000 this year from investments. Same income. You'd assume same tax bill, same lifestyle, same everything. But after taxes, person A quietly keeps tens of thousands of dollars less every single year. And it's not because they spent more. It's not because they earned less. It's because the system treats their money completely differently. Today I'm going to show you exactly how that works, and why understanding this one concept might be the single most important shift in how you think about building wealth. Most people think income is income. You work, you get paid, you pay taxes. Simple. But that's not how the IRS sees it. The US tax code splits income into two very different buckets. And those buckets are not taxed the same way, not even close. Earned income is what most of us live on. Your salary, your hourly wages, year-end bonus, freelance projects, consulting fees. If someone paid you to do something, that's earned income. Investment income is what your money makes while it just sits there. Long-term capital gains, that's profit from selling assets you've held for over a year. Qualified dividends, real estate income structured the right way. Money making money. And here's what nobody told me for way too long. These two buckets aren't taxed at the same rate. The system treats your labor income with one set of rules, and your investment income with a completely different and dramatically more favorable set of rules. Let's start with salary, because most of us live here, and the truth is salary income gets hit from multiple directions at once. The one most people don't think about is FICA. That's the payroll tax. It funds Social Security and Medicare, and it comes off your paycheck automatically before you see a single dollar. For 2026, the FICA breakdown is 6.2% for Social Security, plus 1.45% for Medicare. That's 7.65% gone from every paycheck before federal income tax even touches it. And here's something most people don't realize. Social Security only applies up to a wage cap. In 2026, that cap is $184,500. So if you're at $150,000, you're fully exposed. Every dollar you earn is hit by the full FICA rate. Then on top of FICA, you've got federal income tax. And this is where the bracket system kicks in. For 2026, a married couple filing jointly hits the 10% bracket first, then 12%, then 22%, on income over about $100,800. Now, here's the part that confuses people. At $150,000, you're in the 22% bracket. But that doesn't mean all $150,000 is taxed at 22%. The bracket system is like a ladder. You only pay each rate on the income inside that rung. So for a married couple at $150,000 in salary, after the $32,200 standard deduction for 2026, your taxable income is around $117,800, and your effective federal tax rate ends up somewhere around 12 to 14%, not 22. But now add FICA back in. That's 7.65% on all $150,000 is an extra $11,475 gone before the federal tax calculation even starts. That's the one that quietly wrecks you when you're only tracking your tax bracket. And that's before state income tax. Depending on where you live, that could be another 5 to 13%. California, New York, these states are not gentle. Okay, now let's flip to the other world, investment income. And I want you to forget everything you know about tax brackets for a second, because this works on completely different rules. Long-term capital gains apply when you sell an asset you've held for more than 1 year, a stock, an index fund, rental property, anything you bought, waited on, and sold at a profit. And here's where it gets wild. The federal tax rates on long-term capital gains are completely separate from the regular income tax brackets. There are only 3 rates, 0%, 15%, and 20%. That's it. For 2026, if you're married filing jointly, you pay 0% federal capital gains tax on income up to $98,900. Not $9,890. It is $98,900. That's nearly $100,000 in investment gains and 0 federal tax owed. That does not exist for salary income. There is no 0% bracket for your paycheck. The moment you earn $1 from your job, The government wants a piece. No exceptions, no waiting, no timing. Qualified dividends, the kind you get from most US stocks and ETFs, are taxed the same way as long-term capital gains. So if you've built a dividend portfolio, those quarterly payments are coming in at 0 to 15%, not your ordinary income rate. And here's the part that doesn't get enough attention. Investment income also isn't subject to FICA. No Social Security withholding, no Medicare. That 7.65% we talked about earlier, gone. Investment income skips it entirely. Think about what that means. For a salary worker at $150,000, FICA alone is $11,475 automatically withheld. And for someone earning $150,000 from long-term investments, FICA is literally zero. That's over $11,000 a year in savings just from the payroll tax alone, before we even compare the income tax rates. I want to stop for a second, because I spent years earning more and wondering why my bank account wasn't growing faster. I was focused on income, on the number, not on how it was categorized by the tax code. That was the mistake. Quick pause. If you're getting value out of this video so far, take 1 second to hit the like and subscribe buttons below. My goal with this channel is to help you build real wealth and avoid the financial traps that keep most people stuck. Let's get back to the video. Okay, let's do the actual comparison. Person A, $150,000 from their job, married, filing jointly, in a state with no income tax, just to keep this clean. After the standard deduction of $32,200, taxable income is $117,800. Federal income tax on that works out to roughly $14,700. Add FICA, $11,475. Total federal tax burden, about $26,175. Person A takes home approximately $123,800. Now, person B, $150,000 from long-term capital gains, same filing status, same state. After the standard deduction, taxable income is still $117,800, but now we apply the capital gains rates. The first $98,900 of that taxable income is at 0%. The remaining $18,900 is at 15%. That's $2,835 in federal tax. No FICA. Total federal tax burden, $2,835. Person B takes home $147,165. Person A takes home $123,800. That's a difference of over $23,000 from the same $150,000 of income. Not because one person is smarter, not because one person found a loophole, just because of how their income was classified. Same number, completely different outcome. But the tax rates are only half the story. The other half, and honestly the more powerful half, is timing. Salary income is forced taxation. The moment you earn it, the event is triggered. You can't decide to not get taxed on your paycheck this year. Your employer withholds it. Done. No negotiation. Investment income is optional taxation. You only owe capital gains tax when you sell. If you're holding Apple stock and it's up 80%, you don't owe a dime in taxes until you actually sell those shares. You control when the taxable event happens. This is called tax control through timing, and investors use it in several ways. You can delay selling to stay in a lower bracket. You can offset gains with losses. You can harvest losses in bad years to reduce your future tax bill. You can time sales around life events, like lower income years. Okay, so we've established that investment income has lower rates and more timing control. But here's where the story gets really interesting. It's not just about saving money on taxes this year, it's about what that saved money does over time. Every dollar that doesn't go to taxes this year stays inside your portfolio. It keeps compounding, it keeps generating returns, and those returns generate more returns, and on and on. The math gets enormous over decades. Here's a simplified way to think about it. If you have $100,000 invested, and you're forced to pull out 25% each year for taxes on your gains, you're constantly shrinking the engine. But if those gains are taxed at 0 or 15%, or not taxed at all until you sell, the engine runs hotter for longer. Over 20 or 30 years, the difference between those two scenarios isn't a few $1,000s. It can be hundreds of thousands. Not because one person took more risk, just the system lets more money stay invested longer. That's the actual gap, and it's not an accident. Let me show you the alternate version, where you don't know any of this. You chase a higher salary your whole career. You get raises, you feel successful. Your gross income looks great, but you're handing over a third or more of every dollar, year after year, before you even get to invest. You retire with less than you could have, not because you made bad investments, not because you were reckless, because nobody explained to you that how your income is categorized matters just as much as how much you earn, sometimes more. Now, and I want to be clear about this, this is not a video telling you to quit your job or avoid paying taxes. Earned income is how most people build the foundation. You need salary to invest, you need the paycheck to buy the assets, but the goal over time is to shift more of your income into forms that are taxed less aggressively. That means building investments that generate long-term gains. It means holding assets longer. It means using tax advantage accounts while you're growing. And it means being aware, because every year you don't know this, you're letting the system take more than it needs to, not because the tax code is broken, just because most people never learned how it actually works. Let me recap this fast, because this really does boil down to three things. One, investment income is taxed at lower rates than salary income. Long-term capital gains max out at 20%, and many people pay zero. Your salary can't say that. Two, investment income skip FICA. That's over $11,000 a year in savings at $150,000. Not a small number. Three, investment income gives you timing control. You decide when to sell. You control when the tax event happens. That control, over decades, changes how much wealth you actually build. Wealth isn't just about how much you make. It's about how much you get to keep working for you. And that's determined by the category your income falls into, not just the number. If this changed how you're thinking about income, drop a comment below. And if you know someone still only optimizing for salary, send them this. It might save them tens of thousands of dollars. Thanks for watching, and I'll see you in the next one.